I'm Chartered, your accounting tutor. In today's video and class, we are going to move to what is called financial accounting. If I recall, we have been looking at introduction to accounting. Today, you can see this is financial accounting. Introduction to accounting is like bookkeeping, that is preparing towards financial accounting. So, when we talk of bookkeeping, the process of bookkeeping begins from books of original entry, passing through ledger account, balancing the account, and extracting the trial balance, that is bookkeeping. All the elements, all the transaction and things that have to do with posting into books of original entry, balancing the account, transferring to ledger account, balancing all the ledger account, and extracting the trial balance is what is called bookkeeping. And all that means introduction to accounting. That is why bookkeeping is the foundation to accounting. So if you are introducing accounting, it's like you are doing bookkeeping. So you are right by saying introduction to accounting stand at bookkeeping. So today we are moving step forward, whereby if you have a trial balance and you are asked to prepare the financial statement or what you call trading profit and loss account and the others, you are into financial accounting. And that's why today we are looking at financial accounting. So under financial accounting, the first topic we are going to look at is what is called financial statement of a sole trader. Financial statement of a sole trader. When we talk of financial statement of a sole trader, we are referring to statements that are prepared by a sole trader. The common statement that are prepared by a sole trader, what is called a one-man business. And then these are the common statements that are prepared by the sole trader. And as a learner, beginner in accounting, these are statements that it is expected that any learner in accounting should be able to prepare this statement. And if you cannot prepare it, it means you have challenge in accounting and your foundation in accounting will have issue. Because other accounting topic as we go higher, financial accounting, are linked to these three statements, are almost linked to this statement. So understanding the statement very well is very, very crucial and important. Let's look at some of the statements. Number one, we have what is called statement of profit or loss and other comprehensive income. The second one is called statement of financial position. The initial one is what we called trading profit and loss account in the previous days. Now that financial statement, international financial reporting standard have changed the name into statement of profit or loss and other comprehensive income, which is the latest name used by International Financial Reporting Standard. The second one is statement of financial position, which was hitherto called the balance sheet. Then the third one is called statement of cash flow. Other statements like statement changes in equity and others, but these are the common ones that learners are expected to lay hand on it. As they go higher in accounting, you have statement of changes in equity, statement of value added, and other statement. But at this level, it's expected that we should know these three statements, which will serve as a foundation. And that is why we are going to concentrate on the three. Let's look at the first one, which is called statement of profit or loss and other comprehensive income. This statement, what is statement of profit or loss? Statement of profit or loss is a statement which is prepared to determine whether the business is making profit or loss. It concentrates on whether the business is making profit or loss as the business is trading or the business is going on. That is what the statement is concerned. So this statement is subdivided into three. Number one, segment of it or section of it is what is called a trading account. The trading account. Then the number two is profit or loss account. Number three is other comprehensive income. These are segments into which this statement is being prepared. So we are going to take the statement one after another logically as we understand how each of the statement is prepared in financial accounting. Let's quickly go to the first section, which is the trading account. What is trading account? A trading account is an account that is prepared by the business to determine the gross profit of the business. Trading account is a statement that is prepared in the business to determine gross profit. That is to know whether the business is making gross profit or loss. Whereby total sales or revenue is deducted from cost of goods sold to determine your gross profit. So you're able to get gross profit or gross loss. That is the end of trading account. Trading account is simply to determine gross profit or loss using all revenue minus all cost of sales. That is trading account. So these are the items used in trading account. We have opening inventory, we have sales, we have purchases, we have return inward or sales return, we have return outward or purchases return, we have carriage inward or carriage on purchases, we have wages, royalties, import duties, or in short, we call them direct expenses. We have what is called closing inventory. We have goods withdrawn for personal use. But let us quickly look at the meaning of these items. Because most learners, we know how to use it, but we might not know the meaning of what they are using. So understanding the meaning is very, very important so that as you are preparing in the practical business or elsewhere, you'll be able to appreciate what you are using. What do you mean by opening inventory? Opening inventory are goods that are unsold from the previous year or previous month in taken forward to another month or another year. That is opening inventory. Opening inventory are the unsold goods which the business is going concern, which the business is unable to sell in the previous year or month or quarter as the case may be, which are brought forward to another year or month and become the first goods that the business will have in place for sale. They are called opening inventory. Opening inventory. Most learners confuse opening inventory to purchases. No, it is only an existing business that can have opening inventory. For example, if you are starting business today and then you go to the market and purchase goods to come and sell, most learners take it to the opening inventory. No, it is not opening inventory, it's a new business. So if you are buying goods new to come and sell the business, they are referred to as purchases. They are purchases, they are not opening inventory. It is until when the goods purchased in that very first year are not sold all, and then you carry them forward into the next year or month or the quarter as the case may be, it now becomes opening inventory. And another one, if the goods are not sold, have been sold all, and there is no remnant to take to the next year or next month, then means if in the next year there will be no opening inventory. Opening inventory only occurs when there is closing inventory brought forward to the next year. That is when we talk of opening inventory. I hope you are convinced with that. Second, what we talk of sales. What is sales? Sales simply means goods purchased with sale. Goods that are purchased when they are sold out, in accounting we refer to as sales. They are simply goods purchased when the business sold out. So goods sold out by the business are referred to as what? As sales. That is just what it says. What do you mean by purchases? Purchases are goods purchased for resale. Any goods that you purchase, that is what the business is dealing with. If the business purchased such goods with the intention of reselling it, such goods are referred to as purchases. That is why I remind in my previous video, I keep on emphasizing that if you purchase non-current assets, things like furniture, equipment, motor vehicle, and the rest, and the intention is not to resell it, the intention to come and use it in the day-to-day running of the business, please, they are not purchases. Purchases are those goods purchased for resale. For example, even if you are selling cars, cars become your goods. Though it looks like cars is a non-current car, it's a non-current. No, they are only non-current assets when they are not meant for resale. So any current asset, any asset that is fixed can become goods, provided the business is dealing with such an item for resale. Then in accounting it becomes goods. So purchases are goods purchased for resale. Take it and get it right. Next one, what is called return inward or sales return. Return inwards or sales return. These are goods sold by the business, and then the customer decide to return them back to the business in case of any issue, either damage or not according to specification or overcharge or any reason. Such goods being returned by customers into the business, what we call trade receivable. They are returned back to the business. We call them returns inward. That is why another name is called sales returns. Sales that have been returned. And that is what is called return inward. Next one, what is called return outward or purchases return. Return outward or purchases return refer to goods that have been purchased by the business from suppliers or anywhere they get the goods, and if the goods are being returned back to the suppliers due to any reason like non-overcharge overcharged or damaged or not according to specification or not according to the order, in that case, if the goods are taken to the supplier and the supplier herself taking it, then they become what is called return outward. That's what the next thing is called purchases return. Purchases mean goods purchased. If they are returned back, you can call them return outward. Next one, what is called carriage inward or carriage on purchases. What do you mean by carriage inward or carriage on purchases? Carriage inward refers to the transport cost. The transport fare paid on goods purchased for resale. That is the cost of taking the goods from where they are purchased into the place of destination, including offloading, all this carriage, wheelbarrow, any cost that's associated with trying to bring the goods from where they are purchased to the place of destination, including the offloading, the portals, and all these activities that bring the goods back home for sale. Such costs are referred to as carriage inward, and that's what they are referred to as carriage on purchases. So if you understand the meaning of purchases, you'll be clear here. So if you buy any item like non-current assets, for example, you buy equipment or furniture elsewhere and you pay transport to bring them home, please, I'm warning you, it is not carriage inward. That's why, because transport costs or any other thing. But if it is goods that are meant for resale and you bring them home, in any cost associated in trying to bring the goods home, that is what accounting refers to as carriage inward. Next, we have what is called wages, royalties, import duties, and in short, direct expenses. Wages, royalties, and import duties are what is referred to accounting as direct expenses. Direct expenses are used in trading account. Most lenders feel that wages, royalties, and others should be used under profit or law, what is called indirect expenses. No, direct expenses are expenses that link directly to the cost of goods sold. What we call, they become integral part of the cost of goods sold, meaning that if you are to sell the goods, you must incur such expenses. And any expenses that if you must incur it, otherwise the sale of goods will not complete, we call it direct expense. Let me explain further about the wages. For instance, look at a company like the Indomie company, whereby they employ workers going outside there to be selling their product. So they go out advertising to sell the product. So most of these people that are selling, using the van or any means they use in selling, they pay them on day-to-day basis. Most of them are not workers of the company. But as they go out to buy these, to sell these goods, they are being paid wages. And their sales relate, or their wages relate to how many goods they sell on a given day. So you discover that their wages link directly to the cost of sales. The more they sell, the more the wages. So any expense that link directly to the cost of trying to sell the goods, you attach them to trading account, because in trading account, mind you, I define it as sales minus cost of sales. So anything that link directly to the cost of sales is attached to trading account, and that's why import duty is also there. You import goods and you want to sell. So before the goods land, you must clear them in the port by paying import duties out before you take them home. So such expenses are linked directly to trading, which become integral part of the cost of goods sold, and that is what such expenses are attached to the trading account. Next is what is called closing inventory. In the process of explaining opening inventory, I've already explained closing inventory. Closing inventory is the cost of goods unsold at the end of a trading year. If you purchase goods and the value of those that are unsold, you do not sell them all, what is remaining, the cost of such goods or the value of such goods is referred to as closing inventory. And it's closing inventory that become opening inventory, I already explained. So closing inventory requires the cost of unsold goods in a trading year, end of a trading year. Finally, we have what is called goods withdrawn for personal use or private use. When we talk of goods withdrawn for personal or private use, these are goods that the owner purchased for resale and decided to take them out for his personal use or private use. Such goods are deducted from purchases. And mind you, purchases is an item in trading account. So if goods are purchased for resale and then part of it have been taken out for private use, which is not for business use, it means it have reduced the value, have reduced the quantity of goods available for sale. So it must affect the trading account, which is purchases. And that is why anytime you see goods that are withdrawn for personal, the value is being found in trading account because it reduces the purchases available, which will now reduce the cost of sales. Ladies and gentlemen, I believe that if you follow my video, it is clear that you will understand how we are going to logically explain all these concepts, bring the format, bring questions that are very standard, ICANN standard questions that we're able to address it, so that anytime you have issues on trading account, just refer to my video. Don't forget to like my video, comment. If there's any question you come to us, I'll come back and address it. And don't forget to share it to people that might not understand these things, to be able to understand, so that knowledge will continue to grow. Thank you. I remain chattered.